it gives you an option to do something later, right? So before we start, I want to make sure that everybody knows that options can be potentially dangerous thing, particularly if you don't know what you're doing, right? Half-baked knowledge is bad, right? But options is not like rocket science. It can be understood. You can have very basic understanding of options and you can still trade. You do not have to understand everything. Options is like an ocean, right? So there are a lot of strategies. So there are like more than 100 strategies. We are going to be covering only around 3 strategies today. So you can just understand the basics and you can trade in them, right? So you can, so, but you still have to understand those 3 strategies very deeply, right? So today I'm going to be covering only the basic, but I will be sharing some links and so on for further education. And there is a way to practice your trading as well, right? For example, TD Ameritrade has got Thinkorswim paper money, right? Paper money, they will give you $100,000, right? So you can use your strategies, you can look at stocks and you can buy options and everything. There is no actual money being spent, right? So then you can track on how you are doing, whether you have made a mistake, all those things you can learn with TD Ameritrade paper money, right? So that is one thing. But in general, I wanted you to understand this because it is very easy to lose money if you actually start trading in real money. So I would recommend that you understand the options, you go through other videos and everything, not just this course, and practice using paper money. Then you are ready to trade. And definitely don't sue me if you lose money, right? So that is a basic disclaimer here. Okay, what are options, right? So options are rights. So each word in this definition is important, right? So option is gives you a right to the buyer to buy or sell a specific issue. As I mentioned, issue can be ETF, issue can be stock, issue can be an index like Dow Jones index or Spider, SPX, all those things, right? At a specified price. So the specified price is called the exercise price, right? So you will be choosing the price. We will see some examples that will make it clearer. And one more very important thing is on or before a specified date, which is the expiration date. So after the expiration date, the option becomes worthless, right? So it expires, so it becomes zero.
Question, Nari.
Yeah.
Is that the end of the trading day of that date? Is that what it means?
Yes, yes.
Okay.
Yeah. It is normally for monthly options, it is the third Friday, end of third Friday. And for weekly, it's every Friday, right? So there are monthly options and daily option, weekly options. So it's always Friday, but it is the third Friday. And if Friday is a holiday, it's Thursday, right? So the expiration date, you have to watch out for that, right? So because if you don't exercise your option before that, it will expire. Okay. Now there are 2 types of options. One is call and another is put. So I will be keeping on repeating call and put in several slides so that you fully understand, right? So this is very important to understand. So for the buyer of a call option, it gives you the right to buy a security, buy a stock at a specific price, right? So it don't, if you have like $10,000, right? So if you buy say IBM, which is $100, you will get only 100 stocks. Whereas if you, for the same $10,000, you can be trading on many more of IBM stocks using the option. So if you are really bullish that IBM is going to go from 100 to 200, so if you buy 100 shares of IBM and it goes to 200, then you have just double the money, right? Whereas if you buy a call option, right, call option for $10, and if the stock goes from 100 to 200, your call option will be worth probably $100, right? $110 it will be worth. So that means you have multiplied your money 11 times with the same stock movement, right? So that is why the call option gives you a leverage. Leverage means you invest a little bit of money and you can get more money, right? So, but you can also lose the whole full money. That is also possible, right? But if your guess is wrong, you will lose money. So basically, before you invest in option, you have to have some idea, right? So whether you think you are bullish, you think the stock will go up, or stock will go down, or current market, right? So current market now, like let's say like our SPY or S&P 500, right? It's at 3600 something. If you think that it will go to 4000, that means you are bullish. Then you can buy call options on the S&P 500. If you think that the market is overvalued and it is going to crash, you can buy put option, right? So generally for the buyer of the option, they will buy calls when they are bullish on a particular stock or particular index or particular ETF, whatever, and they will buy a put if if they think the market is going to crash or if the stock is going to crash, right? So this is very important. Any questions?
Nari, one question, Nari, Suresh here. So when you say you buy a call, I mean you put a call, right? That means you have the right to buy.
No, don't say put a call because that's totally different.
I'm
Buy a
sorry.
call.
When you buy a call, right?
Yeah.
So does it mean that it's profitable only if you're actually buying that stock and not just the option? You know what I'm saying? Like when it comes to it.
No, you don't have to buy the stock ultimately. You can sell your call option. So your call option, you are buying at a particular price. You are
Right.
buying at $10,
Mhm.
right? With
Mhm.
an expiration of March,
Right.
right?
Mhm.
But your stock has gone up. That means your call option also has gone up.
That is most probable, right? That's always true.
Yeah. So if the stock has gone up, your call option also has gone up.
Okay.
Then you can just sell the call option.
Got it. Got it. Okay.
Yeah. But
So
not
Nari, you are always buying either call or put. So you cannot sell a call or put.
yeah,
When
you
you
can.
say you buy a call, that
No,
means you
no.
are buying a right to sell.
Yes. But
And when you are
you can
buying a put, that means you are buying a right to
right
sell.
to sell. But yeah,
Okay.
I will be covering the selling. So there are always two sides to the transaction, right? So
Yes.
when you buy a call, you are not buying a call from a bank or from a central place. You are buying a call from another investor. So that person becomes the seller of the call. So there are always two sides to the market.
So you have to have somebody who's
Yeah,
willing
somebody
to
who is
sell.
willing to sell. Yes, yes.
Okay. So
Yeah,
it's always two persons required
two
for that.
person. Yeah. I got some slides which will explain everything.
Okay.
Okay, very good. Okay, let's move on, right? So again, when you say option, it is a short for options contract, right? So it is a contract between the buyer and the seller, right? So gives the buyer the right to buy or sell a specified number of shares of a stock or ETF at a certain price, strike price. It's called the strike price before a certain date. So let us say that if you are buying, say, XYZ or IBM or whatever, right? And one contract is always 100 shares, right? So you cannot buy anything less than equivalent of 100 shares. So if you are not asking questions, please go on mute. So I'm hearing some background noise. So quantity is always 100 shares, right? So the contract is for 100 shares and premium, right? So for the buyer, they have to pay the premium of say $20 here in this example, right? In this example, you are buying a single contract. So when you say $20, it is per share, right? Per share. That means your net outflow is what? If you are buying a single contract with a premium of $20, what is your,
120 bucks.
yeah, $120, right? So because you have to multiply by 100, so you should not make that beginner's mistake, right? So when you understand that you are buying something, you don't, if you don't think that you are buying like 10 options and then put 10 contracts, right? That makes a lot of difference. So it will be multiplied by 1,000, right? So you have to be very, very careful on the difference between the number of options and the number of contracts. When you're executing an order, you will always use the number of contract, not the options, right? So you will say, I want one contract, which is 100 shares worth. And expiration say here in this case, July 2017. So all these characteristics go with option. Okay, so again I mentioned the same thing. So this again and again I'll be mentioning, right? Option multiplier is 100. So the total amount an investor pays for a single options contract equals the price of options premium times the options multiplier. So that is 100. So $20, and you guys already answered it correctly. So times 100. So the investor pays $120 plus transaction costs and brokerage commissions and fees, right? So there will be some transaction costs. Most of the brokerages, they have waived all the transaction costs on brokerage fees for stocks, but many of them are still charging for options. For example, in TD Ameritrade, I use TD Ameritrade, they charge 65 cents per contract. So
Okay.
so in this case, I would have paid $120, 65 cents, right? So total.
It's for a buy or sell transaction.
Yes, buy or sell. Yes,
They charge 65 for each contract.
for each contract. Yes.
Okay. And sorry, can you explain again this? The premium is what actually?
Premium is per share cost. When a seller will get the money and a buyer will have to pay, right? So you are buying a contract, by an option contract, you have to pay premium. Buyer always pay the premium, seller always gets the premium, right?
Okay. So how do you decide that it is 20?
Yeah, I'll come to all that.
Okay.
So let's keep moving. So option expectations, right? So buyer expectations, again, for calls, they are bullish. They think that the stock prices will rise, and puts, they think the stock prices will fall. Whereas the guy who is actually selling you the options contract has got other ideas, right? So he has got totally opposite idea. That is why he is selling you a call. He thinks that the price will fall or stay level. That is why he is selling you the call option. And similarly, he is selling you puts because he thinks price will rise or stay level. Okay, it is contrary expectations. Buyer and seller, they do have totally different expectations. That is why there is market, right? So if everybody, the whole world is thinking stock prices will rise, nobody will sell the option. Or selling the option is also called writing the option, right? So the seller is called writer. So again, I'm just repeating this so that we all understand. So a buyer will be bullish when they buy a call, and buyer will be bearish. Bearish means they think the stock will go down, right? They will buy puts, and seller will sell calls when they are bearish, and they will sell puts when they are bullish. So I've repeated myself several times because repetition is important for memory, right? So understanding.
Right.
Okay. Again, now there is a slight twist here. So we were only talking about rights so far. Buyer rights buyer has a right to buy the underlying stock when they buy a call option. and buyer has a right to sell the underlying stock uh, when uh, when uh, when they buy put options. But the seller doesn't have rights, right? They have obligations. Why?
To
Because
sell.
they are getting premiums, right? They are getting premium, right? And that is why they are obligated. So they are obligated to sell the underlying stock. If they say, because it's a contract, right? So both parties have to be bound by it. So if the seller backs out at the end, then the whole thing collapses. Like this is like Trump not getting out of the White House. Right? The whole thing collapses, right? So the seller is definitely obligated to sell the underlying stock if those prices, the contract is exercised by the buyer. And similarly, the put option seller has to buy the stock, So that is why the risk is very, very high if you have what is called a naked put, right? Because the stock can go up tremendously, but you go down tremendously, you still have to buy, right? So it is a tricky thing.
Nari,
And
Yes.
sorry,
Nari, quick question.
yeah.
Okay, some display is coming. Sorry. So in that scenario of selling, right? So the person is always owning the stock. The seller is always owning the stock also, other than owning the option.
So there
There's
are
no
two.
stock.
Wait, let me answer, guys. So so there are two scenarios, right? So that's a good question.
Okay.
So if they have the stock and they sell option, that is called covered call or covered put, right? So they have the stock and they can sell calls, they can sell puts. That is called covered call and covered put.
Okay.
Whereas if they don't have stock and they are still selling the options, that is called naked call or naked put.
Okay.
And that is risky, right? Because naked is always risky because you are selling something, you don't know what will ultimately happen. If let us say that if you are selling a call, right? And then you don't have the stock, you just said I will sell the stock at this $110, right?
Yes.
But the stock goes to $200, right? So definitely the buyer is going to exercise his option, call option, right?
Yeah.
So then they have to go to the market and buy to $200 and sell it to them for $110, right? So if you have a naked call or naked put, that is pretty risky.
It is risky for the seller.
Yes, for the
Yeah.
seller. Buyer never has too much risk. So the buyer is always risking the premium.
Right. That's
Right?
all. Yeah.
Yeah. Buyer.
Nari, buyer can never be naked.
Right. Yeah. The naked is only for selling, right? Naked
Yes.
means you don't have it and you sell it. Right. So buyer is probably naked. They don't have the stock. They want to probably buy it at a specific price. That is why they are putting. The only other risk which is on buying is, suppose if you buy a call, right? If you buy a call and that call option expires on that day, right? And you have not sold the call option or something, then you are bound to buy the stock, right? So you have to buy the stock at that price.
Sorry, can you explain again?
So I have another slide. I will explain that more. But
Okay, because this is not clear to me.
yeah, right. So what I was saying was, buyer is also obligation. There is one obligation for the buyer,
Right.
right? If the stock has gone up, right? The stock is what is called in the money. Then and you have not exercised, you have not sold off the call option. Then on the expiration date, you are automatically buying the stock. You have to have enough money to the stock. You are still making money, but you are obligated to buy the stock. I'll explain that later.
Okay, you explain it because it's still not clear, because I thought when you don't exercise your right to buy, then basically your
Yeah,
whatever
you,
money you have given is lost because you already paid some money, right?
yeah,
For
you
buying
have
that.
paid the
And now
you
you
have
didn't
paid the
exercise it, so
premium.
you lost that money.
You have paid the premium that is lost,
Yes.
but when it expires in the money, I will you have to understand all those terms. So let us
Yeah.
hold on to that question.
Okay.
Yeah, so again, 1 minute, Nari.
Yeah,
You said there is a naked call.
yeah.
What is the naked call?
Naked call means I am selling the call, right? But I don't have the underlying stock. I am selling you 101 contract of IBM shares, right, at a particular price or per a particular date, but I don't have IBM stock. So I am obligated to sell you at that correct price and the correct date. So that is called naked. If you don't have the stock and you sell the underlying option, then it is naked.
Yeah, so
That means you are also
naked apply
able
only
to
to the
say-
put.
I'm sorry.
Naked will apply only to the put.
Both calls and puts, seller side. So you
Okay.
don't have stock, you sell call option. You don't have stock, you sell put option. Both are possible.
No, but in the put option, isn't it? He has to buy it, need not own it, isn't it? In the put option, put for the seller.
Right.
That if you have examples, maybe it'll get clearer.
Yeah,
I think.
right.
Yeah.
Okay,
So
we
let's
will
just hang
come
on
to
for a
that.
little bit.
Nari, the difference is if there is no underlying instrument, it is naked. If there is an underlying instrument behind the option, then it is covered.
Covered. That's it. Yeah.
No,
That is the difference.
So when you say
so
underlying instrument, it's
yeah,
like
what do you
old
mean? There
instrument.
is
This not
always an underlying instrument, right? So
Held by the seller.
yeah,
Held by the
owned by.
seller.
Yeah, that's own is the keyword. Yeah.
Held by the seller. Yep. I'll go
Okay.
back and mute.
So okay. So bias for calls is contract gains in value when underlying stock increases, right? So when the stock is going up, the call value will go up. Whereas the contract gains value when the underlying decreases. Right. So if you bought a put option and the stock keeps going down, then your put option is going to gain value.
And that's a standard value determined by the market, right, Nari? It's not like
Yeah.
an individual
Yeah,
determination.
because there are some calculations for options, and obviously when the price is still reducing,
Mhm.
then there are two components to the price. One is time value, another is intrinsic value. Intrinsic value will keep increasing if the stock goes down for a put option. So I have some slides later on.
Okay.
Okay, so these are some general questions, right? So why do you have to trade options, right? So people might think, you guys might think that you are trading in stocks, you are comfortable with trading in stock, buying, sell, or you're just investing, buy and hold, whatever, right? Why do you have to learn about options? Right, so there are three general scenarios, right? So if you look at the bottom, right, you can generate income or make money, which is the speculate, right, and hedge whatever you have, right? So all those scenarios are possible. Okay, let us go one by one, right? So this is important to understand why you have to trade in option, even if you don't, why do you have to learn about options, right? So I think everybody has to learn options, because even if you don't want to speculate, you can you have to still hedge whatever you have. You have to protect whatever you have, right? So there are some hedging options, hedging strategies. So you have to learn about options, even when you don't want to actually keep on trading in options all the time, right? So you are not a day trader who is trading in options all the time, but you still have to have some understanding of some basic strategies in options. Why? Okay, first is make money, right? High rewards if you guess right, right? So higher leverage with the same investment. So I explained that, right? So IBM stock is currently 100. You think that it is going to 200, right? So you buy the IBM stock. So you invested $10,000, and but it is going to $20,000. So you just double the money. Whereas if you buy options at $10, and the options at the end of period when the stock actually goes to $200, your option is going to be worth $110. So that means you have made it 11 times, right? So instead
And
of
Nari, can you explain that again? How did you come up with 11 times? I'm missing that.
okay, so okay, let us say that you are buying IBM stock, right? Let us just focus on IBM stock, and let us assume that it is currently selling at $100, right? So you think that it is going to go to $200, right? So what are all the options? You tell me. What will you do if you don't know options? What will you do?
No, you're right. I agree with your assessment of that. Like, if I buy 100 shares of IBM, then for $10,000, when it goes to 200, it doubles. I
Yes,
get that, and I also get the purchasing at $1.20. I get that, but what I did not understand is
so
when it goes to
what,
200, how did it become 11 times? Is what I
correct,
missed.
correct. Okay, so there are two strategies here, right? So there are two bullish strategies. One is to buy the stock and hold, right? Another is to buy the call option.
Right.
So I am saying that, let us say that you are buying an IBM call today for $10, and the call will expire in say 6 months time, right?
Okay.
So you are buying it $10, right? So you have already instead of buying the stock at $100, you have bought call option at $10,
$1,000.
$1,000.
$1,000, right? Now the stock has actually gone from 100 to 200 in say March time frame, right?
Okay.
So then the option, because the way the option is valued, it will have intrinsic value,
Sure.
right? So it will have the intrinsic value will actually go from 10 to 110, right? Because you have bought it at an exercise price of 100, right? And that means even if the stock is selling at $200, you can still buy the stock because you have the call option at $100.
Okay, got it.
Right? So that
Yeah.
means you are making $110 out of an investment of $10.
$10. Oh, got it. Understand. Okay.
So
Got
that
it. Thank
means
you.
you are making 1100%.
Yep. Understand.
That is where your leverage comes in.
Yep. Okay. Thank
Okay.
you.
On the contrary, if IBM stock doesn't go anywhere or it goes to $90, right, then your call option is worthless and you lose your $10. You lose your 100% of your $10.
Sure. Got it. Understand.
So high rewards and high risks, right? So trade options.
Nari, one basic question, Nari. So all this is only if there is somebody to buy at that price, correct?
Yeah.
And
There
that
is
is the,
yeah, there is always so that is why you have to buy options. You have to trade options in some highly liquid stocks.
correct. But is that like a pool approach? You're not actually going to a buyer, right? You're just saying I'm out for selling and somebody brokerages it or something, right?
No, you don't know who is selling your call option, right? You
Got it.
just go to put TD Ameritrade or E-Trade or Robinhood or wherever, and you put an order. And the broker will match that with whoever wants to sell it,
Okay.
and they will give you as soon as your order is met, they will close that order, right? And they will deduct
What is the pecking order? For example, Dinakar has the same thing I have, let's say, for example, right? How will you know that whether his is picked up first or how is that order determined?
yeah, if everything is the same, it will be the first in first out.
I see. Okay.
But the volume, see, you should not be doing trading options in low volume stock which nobody knows, right? So you should be trading options. I normally trade options in SPY, right?
Yeah. That's a
SPY is an ETF
Mm.
which has got Standard and Poor 500 stocks, the biggest 500 companies
Mm.
in USA, right?
Right.
So in one stock, SPY ticker, you can buy the whole market, almost the whole market, 500 biggest.
Correct.
So I generally trade with SPY. So there is always a buyer and seller, whatever price you want, all right? So there is, but if it is totally out of the money, then there may not be buyers. So there are some conditions. If you go for a specific price for a specific date, there may not be any sellers, or so your order may not be fulfilled,
Got it. Got it.
right?
Mari, I have a question. This is Saji.
Hi.
So, when you make, let's work with the IBM example for a second. If we have to make a call on IBM for one contract, and we give a strike price of $200, and we say that it's valid for 3 months. In between the 3 months, anytime can we exercise the call, or does it have to be on that specific date?
You can exercise anytime on or before that date.
Okay.
So you can exercise you can you can exercise and close it out, or you can just sell the call at the current market price.
So if IBM stocks is at like 120, from 100, I bought the call at 100 with a $10 value, and say it goes to 120. I decide to exercise,
Generally people wouldn't exercise. They will just sell the call at the profit.
Oh, okay.
That's what they do. They make they don't have to be committed to the stock.
Okay.
So
Thank you.
Then the next reason, right? So this is a very important reason for most of you guys. You guys have money, you have invested, but you do not have any protection, right? So you do not have protection. So if the market crashes tomorrow, like it crashed in March, right? Then your portfolio value can go down drastically, right? So one scenario you can do is you can buy some put options. You can buy, they're called protective puts, right? So to some extent they will compensate your loss of portfolio if you play it right. If you are definitely sure that the market is going to go down, which a lot of people think right now because the market has gone up tremendously, right? So if you think that the market is likely to go down within the next 3 months, even temporarily, right? Even temporarily, if it goes down and then comes back up also doesn't matter, right? Even temporarily, if it goes down, then all the put options that you have bought will gain value, right? So if the market tanks, your portfolio is going to lose value, but your put options are going to gain value, right? So to some extent you can do hedging. So this is what I did, right? So in February, I thought the market was overvalued, right? So I bought some put options, right? So in March, the whole thing tanked, right? So my put options, they were, I think they were like, they went up like 5,000%, right? So they went up 5,000% because the market dropped so much, right? Still my whole portfolio was down, right? So my whole portfolio was down, but whatever I bought, it went up crazy, right? It went up crazy amount, the put option. Then when it went up, I sold it. I did not sell any of my stock, and then the whole thing recovered and it was fine, right? But temporarily the stock crashed, and I made money because I bought put options in February, right? Before the market goes down, I bought put options, and the put options went up in value, right? But there are many cases where I have lost my full put options, right? Because the market kept going up. I bought put options, right? Actually, I bought some last week. I thought there is going to be some uncertainty with the elections and everything, or I don't know, civil unrest, whatever can happen, and the COVID is increasing. So I bought some put options last week, right? So they have slightly gone up because the market has gone down a little bit in this week, right? So my put options have gained value, but there is no guarantee, right? So suddenly tomorrow the market will go back again, and my put options might become worthless. So it's a guessing game, but it gives you option, right? So option is holding true to its name. So if you know how to do it, so it gives you some option instead of losing your full portfolio, right? So if you think that the market is fully valued and it is not going to go up, what can you do? You can sell your stock, you can convert to cash, right? But if the market keeps going up, and that is a problem, or if the market dips temporarily and then shoots back immediately, then you have lost on all the appreciation. So if I had sold my stocks in February instead of buying protective puts, if I have sold all my stock in February, then okay, I'll be very happy in March because the whole thing crashed. But then it kept going up and up and up. I would have, if I have not bought, then I would have lost money.
Got it.
Right?
So
So
in
it's
that
very,
case,
very,
So Nari,
yeah.
that means this is that when right now when all these indexes are highest, is a good time to buy put, which you did already last week.
Yeah, I think it's good time to buy put, but obviously don't quote me or don't sue me, right? Because you can lose your full put value if, because people like other day Bisham was saying that it's going to go up 10%, the market. It might go up because with the vaccination, and generally January it goes up, right? So it might go up. If it goes up, then you might lose. If it doesn't come down at all between March. So I bought put options for March, expiring in March, right? So I have the flexibility. Anytime market tanks from now to March, then my puts are going to gain value.
but
Right?
just to understand that one decision where you own the stock and you actually bought put options, is that the way to say it? But that put option, then is it a naked put? Is that what it's called? It's
No.
related to the
See,
stock.
I am buying. When I am buying option, there is no such thing as naked. Right? So that is only in the seller side you call it naked, right? So
Got it, okay.
when you buy, you are just paying the premium and you are getting the right to for the option. That's it.
Nari, do you ever engage in selling? Are you ever been a seller, or are you mostly a buyer?
I sell calls.
Okay.
So I sell, actually I have some slides that is called covered call.
Okay, right,
So
right.
when I have stock like SPY, right, I sold covered calls and made some, that's an income strategy also. You can make some money out of it, but at the same time, if the market keeps going up, then you have to sell your stock, right? So
Right. Right, because
we'll
so if
cover
you're a seller of a call, then you're bearish.
naked call selling is very dangerous, but
Right.
covered
Covered calls, yeah, got it. Okay, thanks.
covered call is a good strategy.
Yeah.
Mari, I'm still not clear on your portfolio, that example, right? So you already own a portfolio. At this time, you do not own any options. You are just, should I say, you're buying put options?
Yeah, I'm buying put option, yes.
And you relate it with that portfolio. How do you do that? You just call it out as SPY or
No,
whatever.
it is just balance, right? It is just money, right? So if I have $100,000 portfolio, right?
Right.
If I buy, like, say, if I
something with that footprint, then you know that you're compensating for that. Okay.
Yeah. So one is going down, portfolio is going down, and put is going up. So it is just compensating.
Okay,
it won't compensate fully.
Right, I understand.
You have to pay a lot of premium if you want to fully protect your portfolio. Then you are not going to make any money.
Right.
So
it's like paying high premium for an insurance, basically.
Yeah, it is like insurance. Yeah, exactly.
Got it. Okay.
But your put option goes up in value if the market tanks.
Got it. Yeah, that I understood. Thank you.
Okay. The other strategy is exactly what Shashank said, right? So I have the stock, right? The stocks are maybe they are like Google and Apple. Apple pays dividend, but Google and Tesla and so on, they don't pay dividend, right? So you can sell the calls for stocks that you already own and get the premium, and that is called the covered call strategy. So you can just increase your income, right? You are normally, when you have stocks, you get only the dividend, but by having a cover call strategy, you can slightly increase your overall income for holding the stock, because you are getting the premium, right? So that is called the cover call strategy. That is a good strategy as long as the stock doesn't go up too much. If the stock goes down, no problem, you already got the premium, you do not have to sell the stock, you are good, right? But if the stock has gone up tremendously, right? In the same example, let us say that I have 100 shares of IBM, right? And currently it is trading at $100, right? And I am selling a covered call and I get the $10 premium, right? I get the $10 premium, I'm very happy. But suddenly the stock has gone to 200, right? Then I am not going to participate in the appreciation. All I have is only $10. I'm going to miss out on the 200 minus 100, which is $100 appreciation, right? If the stock appreciates quite a lot with covered call strategy, I am not going to benefit in the stock appreciation. That is the risk in covered call strategy. Understood? Okay, so then some commodities like oil, they don't sell stocks. You have to buy it as options only. So there are some good reasons why you guys have to learn options, right?
Hari, have you sold any covered puts?
No, I only either I buy calls or puts and I sell covered
Sell
calls.
covered calls. Okay.
Yeah,
Any reason why
the risk is very high.
for a covered put?
Yeah.
Okay. I guess I'm not understanding that yet, but I'll wait for
Yeah,
you to explain.
yeah, we'll come to that. Okay.
Okay.
Now let us talk about risks, right?
Yeah.
So there are risks, totally varies different depending on the strategy, whether you are on the buying side, whether you are on the selling side, or whether you are selling puts or selling calls, or buying calls or buying puts. So and there are different strategies. There are some strategies which is like straddle. You buy and sell, right? So at the same price. So there are so many different strategies. So the risk totally varies by strategy. So we have to understand the risk based on the strategy. And the other risk is you may lose your entire premium. So if you're buying some call option or put option, there is a good chance if the market goes against you, what you think you do, you might lose the whole premium. And there is one more important point, which is called the time decay, right? Because one of the characteristics of options is that they expire. They have a specific expiration date. You cannot renew past that, right? So when it expires, right, it is going to have zero value. So whenever you buy any option, it is not only going to, even if nothing changes, your stock price doesn't change, right? Even then your option will keep on decreasing in value, because it might expire worthless, right? So the closer to the expiration date, particularly in the last month, right, the options decrease in value very rapidly. So that is why they don't recommend, when you are buying the time frame, don't just buy 1 month out, right? Buy always 3 months out or something like that, 3 months out or longer, so that time decay is not a major factor, right? So you have to remember that options keep decreasing in value.
No, because the risk is known, as the time is coming, you can be more certain where we are. So actually, it will reduce.
Right. So risk can become unlimited also, you may lose much more than the premium you get if you sell a naked call and some other strategies, right? So if you
Yeah.
don't have the stock and if you sell the call, then if the stock goes up, you have to buy the stock at the appreciated price.
Hmm. But then you need a lot of money for that to cover your calls. So person who is doing covered calls, covered puts, then he has to have a lot of money with him. Whereas otherwise, he can be
Yeah.
playing without much money
No,
with him.
that is why, yeah, they might, that is why that brokerage can give you what is called a margin, right? And
Hmm.
if you lose too much money, they will say margin call. They will say we cannot lend you any more money. Margin means basically the TD Ameritrade or whoever is lending you money. If you
Okay.
take a risk and then if you lose too much money, then they what is called a margin call. Margin call meaning they will ask you for money right now, and if you
Okay.
don't have money, then you are in a bankrupt
Trouble.
sort of a thing. So that is why you should really understand the strategies before you do anything, right?
No, it's a very tricky thing. You can make a lot of money, but I think understanding is very important, and better to
Yeah.
start with some, I think, low risk
Yeah.
to understand it better. And when
Okay.
you
Yeah,
understand,
I think we are going a bit slow. Let us keep going.
yeah,
Education and full understanding of how options work is key, right?
Mm.
We can make major mistakes. And major mistake, for example, newbies may not realize you're not dealing in shares. You're always dealing with contracts which are 100 shares worth, right? So that is one risk. But you can, as long as you understand, risk can be controlled with correct strategies.
yeah,
Okay. So I think we covered this already. Premium is what you get per option. So contract means 100 options. It will be multiplied by 100. Exercise price is the fixed share price for future transactions. Expiration date. So we already discussed that. So guys, please go on mute. Getting a lot of background noise. So for regular options, they expire on the third Friday of the month. For weekly options, they expire every Friday. So I think we covered all these things.
very good.
So then there is a concept of in the money, at the money, and out of the money, right? So in the money means the option has intrinsic value. So for a call, right? So the strike price, this is all for calls, right? So for strike price is below the current stock price. That means you say that option is in the money, right? And when both are close, when the strike price and stock price are sorry
Hey,
guys,
can you guys, can Vara go on mute, please?
yeah, Vara, please. So
Hey, Nari, you should be able to mute him.
yeah.
Just mute everybody.
So where is Vara? He's muted. Okay. I think. Okay. So at the money means they are close. Strike price and the stock price, they are close to each other. And out of the money is an option with no intrinsic value, right? So you're buying a call option with a strike above current stock price. So that means in that previous example, the current stock price of IBM is $100, right? And you're buying a $200 call option. You think it will go to $300. So you buy a $200 call option and that will be out of the money. It will be very cheap to buy because people may not think that it will go to 200. So they will sell you at a very cheap price. So that is out of the money, OTM. Okay, so this is going to take some time to explain. So this is called the option chain. So before you buy an option, you have to understand how an option chain works. So I mentioned that option always relies on an underlying symbol like SPY, right? So that is what I mentioned, S&P 500. And you can just choose calls and puts or just calls or puts. and the range near the money, which is at the money or out of the money or in the money, you can select. And you can select the expiration, strike price, and then click view chain. This is what you get. So it says Spider S&P 500, biggest stocks of S&P, SPY. So this is the bid price, right? So at the market, so bid means this is people are willing to pay that much, and ask means people are willing to sell for that price. So the difference is typically taken by the broker. And this is the last selling price, and this is current today's change. And BA size is 500 times 100. So this is also in 100 shares. So there are 500 stocks, 500 contracts people are willing to sell, and total, and 500 are ask is sell, right? So it's evenly matched. This is basically demand and supply, right? So these 500 contract, this is number of contracts, and this is the current. These are all related to the stock.
So the
Right?
BA is actually bid and ask, is that right? So,
Yeah, bid and
ask size. Okay.
Yeah, bid and ask size. Okay. Then you have the calls and puts. So this is related to the underlying stock, and calls and puts. So you have the expiration date, December 2, 4, 7, 9, 11, 14, 16. And then these are all weeklies, right? So weeklies can be on many days. So these not just Friday, they have a lot of weeklies right now. Whereas this is the normal stock, right? So this is the third Friday of the month, December 18th. So December options expire on 18th, right? So it said 16th because I took the screenshot on the 2nd, right? So when I was preparing for the previous presentation, I took a screenshot. And this side is calls, the left hand side is calls, and the right hand side is puts. So the first line says $364 call. So the current price is 366, right? So the 364.0 is the exercise price, and the option is valued around $7, right? So because it's already in the money, because 364 is less than 366, right? So it's already in the money. So $7, 704, 711, right? And change, how it is changed from previous day, and volume. And next one is OPINT. OPINT is open interest. So that means there are that many contracts are being in the market. So there are a lot of contracts open at this time. And volume is the current volume of contracts open for buying and selling, whereas open interest is the cumulative, all the things. So basically you want to look at both to see whether people are interested in buying and selling. So volume gives you an idea whether people are interested in selling and buying at that current price. And similarly, puts is also a different thing, right? So 364 put is only 481, 484, like that. So I'll show you the next slide also, that might make it a bit clearer. So when you're buying the option, this is from TD Ameritrade, but it depends. All the other things also will have similar thing. So option strategy, a single order, right? Is on the left. So it can be a single order, it can be a complex strategy as well. And underlying symbol is SPY, and it can be a stock, Tesla, it can be IBM or anything like that. And when you click on the option chain next to it, that is when you get the previous page, you get the full details. And here you are trying to open a buy to open one contract. One contract means how many shares?
100.
Yeah, 100 shares, right? So that is why the price of 219, it's coming to $219 because it's 100 shares. So even though you're buying only one contract. And expiration date is March 19, 2021. And strike price is 400. So currently it's around 367. So you want to buy a call option for 400, right? And so it says call put call, and it's a limit order. So you are saying 2.19 because you looked at the right hand side. You looked at the right hand side and see that the bid and ask price, right? 214, 219. So you have to put the ask price here if you want to buy it, right? So if you put 219, then your outflow is $219, right? So this is pretty much out of the money stock because the strike price is much more than the current price. Current price is 367 and the strike price is 400. So it is out of the money. So that is why you are able to get at a cheaper price, $2, right? So you buy a $2. So what this means, if you have bought this until March, right? So if the stock price keeps going up, then your option price keeps going, is going to keep going up, right? 240. If stock price goes from 367 to 380, right? So your option might go from $2 to $5. So if it goes from $2 to $5, you have already made like 200% or more profit, right? You can just sell it, right? So that is possible. And let us say that if it goes to 420, right? So 420, and you did not exercise, you did not sell this call, right? You are holding on, you are not doing anything. You just bought this call for 400. You totally forgot about it, right? And the stock has gone to 420 on March 19th, 2021. So if the stock has exceeded the strike price, then it will be automatically exercised. So that means you will automatically buy 100 shares of SPY. So at $400, right? So that means you have to have $40,000 in your bank account, right? So you even though you are dealing with only $219 premium, you have to know that if you put a call option and forget it, and if it becomes in the money, it will be exercised on the last day, right? You will order at the 4 p.m. on March 19th. Your account will be debited for $40,000, right? And you will get 100 shares of SPY, but the market is already 420, right? You are still making money, right? So it is worth $42,000, but you are buying it for $40,000. But if you don't have money, then it's a problem, right? If you don't have money in your bank account, and if you are buying a call option and you forgot about it, that is a problem, because bank is going to ask you for money, right? The when I say bank, like TD Ameritrade and so on, right? And then you might have to have enough liquidity to even if you sell immediately the 100 shares, it's going to take some time to get the money, right? So you have to make sure that you have enough money before exercising, putting in a call option. Is it clear?
But if the price go below, say let's say it is 390, then nothing happens.
Yeah, if the price is 390 and if it expires, nothing. You just lose your premium. That's it.
So
Whatever
Nari,
yeah.
if you actually sell the option on that day, then you make whatever 53 plus 2.19, whatever 55 times 100, right? $5,500, right? Is the value correct? 367 minus 420.
Yeah.
So-
If you right, it will
Right,
be the
okay.
money.
It'll be in the money. Okay, got it. Okay.
Yeah, it will
So
be in the
Shashank,
money.
can we just walk that through? So it's like 420 on March 19th.
420 minus 367 is about 53 plus
Yeah.
2.19. So that's
Right.
about $55, 55 times 100,
No,
5,500.
it's actually not 367. 367 doesn't matter at all. That is today's price. The price that matters is the strike price.
Oh, right. 400 minus
20.
20. Yeah,
Yeah,
you're right. You're right.
420
Right. 400 minus
minus
20. Yeah, sorry.
400.
Thanks. Yep.
Yeah.
So yeah, 20 plus 2.19. Yep.
Yeah.
Got
So
it.
today's price only determines how much
Yeah,
premium you're
what
going
the
to.
value of the
Yeah.
contract is. Yeah.
Sorry.
Yeah.
So the guardrail on this would be then on March 18th, if I still have the option with me, I just sell that option, right?
Yeah. Yeah. You can sell it. You can put you can put a.
Come what may, basically come what may is what I'm saying, because you don't know whether it's good. I mean, depending on, of course, it's 400, it'll go up, but I'm just saying,
Yeah.
went down. At least-
Nari, people like TD Trade will send you a notification, right? Saying, hey, your option's
Yeah,
going to
yeah,
expire
yeah.
tomorrow, right?
Yeah,
So
yeah.
it's not like it's such a big risk that you'll forget.
Right. But
I mean,
that on the flip side,
Hmm.
does TD Ameritrade require that you have to you have to cover it in case you forget, or there's no such thing?
Oh,
You
of
know what I
course.
mean?
Yeah,
Like if
yeah,
you,
yeah, right,
Yeah,
right,
yeah.
sure.
yeah.
They,
So do they allow you? Is there some, some?
no, they give you some margin, right?
Okay.
They give you, they will deduct it. So if you
Okay.
don't have the money, they will lend you and deduct it, right?
Okay, I see. Okay.
Yeah.
Yeah,
So that is
mo-
called margin. So you have to have a relationship with them, and then you have to apply for margin and all that.
Right.
If
And
you want,
so that's a, that's a
most likely,
prerequisite to even do this, the options.
they automatically so you have to convert your account
Yeah.
to options trading account. At
Yeah,
that
okay.
time, they automatically give you margin.
Okay, got it.
Okay.
especially on the, if the price is going closer to the expiry date, the price of the option will also go down.
Yeah. Price of the option also.
So although you
because
pay
see,
219 in the beginning,
options have,
you may get only 150.
yeah, two things, right? Time value and intrinsic value.
Yeah.
Intrinsic value may be there if it goes above 400, but if it is 390, right? There is no intrinsic value because it is less than the strike price, and
Yeah.
there is no time value because that it has expired. So that is why most of the options, almost 90% of the options expire worthless. That is why if you have a good stock portfolio, you can keep selling covered call and make some premium, because a lot of options sell worthless, they expire worthless. Okay. So I think we have covered this slide. In the interest of time, I will skip this, but I think we have covered this already. Okay. So so it's already 9:25 and Zoom didn't kick us out. Okay. So there are some characteristics. When you say long, it means buying. Okay. So don't get confused with long and short. Long means buying, short means selling, right? Just remember that. So it doesn't matter sells or calls or puts. When you say long, it is always buying. So this is a long call. That means you are buying a call, right? So proficiency level novice like us, right? So who don't know much about options, we can trade with this strategy because it's not that complicated. And we think that the market will go up. Direction is bullish, not much volatility. And asset leg is only one leg, which is the long call, and maximum risk is capped, right? So what is the maximum risk for a long call?
You'll just lose your premium, right?
Yeah,
That you paid.
exactly, right?
Yeah.
Exactly, right? And what is the maximum reward?
It's unlimited, right?
Yeah, because if the stock keeps going up, you will
Yeah.
get a lot of
Yeah.
And the strategy is a capital gain. It's not an income strategy. It's more of a capital gain strategy.
Yeah.
Advantage, cheaper than buying stock outright. I gave a detailed example before. Leverage, uncapped profit potential with capped risk, right? So you got your rewards are unlimited, but risk is limited, which is a good strategy, right? But disadvantage is potential 100% loss if you badly choose any of those things, and high leverage, right? So you don't want that. So next one, this is the example of the same thing, right? So this is what we said. Maximum risk is call premium. Maximum reward is uncapped, and break even, right? No loss, no gain when the stock is at call strike plus call premium. So example here, right? So ABCD stock is trading at 28.88 on February 2014. By January 2005, strike call to 27.50 strike call at 430 for 438 premium. So your outflow is immediately $438, right? But for a particular stock here, see, he's talking about risk, but it'll be times 100, right? So maximum risk, you're going to lose the premium 438. Maximum reward is unlimited, and break even. So if the strike price plus call premium, if the stock is that level, you won't lose money, you won't gain any money. So you won't lose your premium because you got it. The stock has already appreciated that much. So only if the stock goes above 31.88, you make money, right? Exercise price, so that is the strike price plus call premium, that becomes your new break even. So that is one important thing to remember, right? So if you just go and buy stocks for 28.88 on that day, anything, if it goes to even $30, right, you're still making some money. You're making some paper profit. Whereas if you're buying call option, because you have already paid $4.38, your break even is going to be higher. You're going to be making money only if the stock goes above 31.88. That's an important point to remember.
Nari, quick question. I'm a little confused as to why on the next. I mean, if you go back to the previous one, yeah. So given that it was trading at 28.88 on February 19th, 2004, you bought the January 2005 at 27.50 strike call, is it?
Yeah.
Why does it go?
You are buying in the money strike call.
In the money call strike. Okay, got it. Okay. Yep, thanks.
Okay, so next we'll talk about long put. So again, the proficiency is novice, right? I mean, I've been buying, so I don't know anything. So, and
That's not true, Nari. Yeah.
Yeah, this is like I don't know, bearish strategy for long put, right? And maximum risk is capped. What is the risk?
The premium,
right? So the premium again, and maximum reward is uncapped. So if the whole market crashes a lot, that's what I was saying, right? So my stock put option went up like 5,000%, right, when the market crashed. So it was quite a lot of gain, right? So advantage, profit from declining stock prices. You cannot do this if you are just buying the stock. See, you can short sell the stock, but short selling the stock is also very very bad actually. It's a risk. So even you get better leverage even than simply shorting the stock. Uncapped profit potential with capped risk. Again, disadvantage, you can lose your whole premium. If the market keeps going up, you lose all your put premium. Yeah, that is the risk. So example here, same example, except that it is put now. You pay 438. You might lose the whole thing if the market goes up. Maximum reward is $30 minus 438. You can get, if the stock goes to zero, right? Still you can sell it at $30. Even if the stock goes to zero, you have the right to sell at $30. Then that means you are making 25.62 per option. And break even.
In that case, somebody should be willing to buy it at that price too, right?
What do you mean?
No.
You are the one.
No, it doesn't. That's the.
You are the one who is buying the stock.
Right.
Right. So Break even is 25.62. Yeah.
Remember, it's the right. You have the right to sell it.
Yeah. Okay. So the last strategy we will cover is the covered call strategy. This is also a novice strategy. Direction, if you think that it is slightly bullish or if it is stable, right? If it is stable. If it is too much bullish, then you might lose the stock. So this asset legs has got two strategies here, long stock plus short call. That means it is a combination, right? So buy stock, or you might already have the stock, right? So even then it is called a covered call. So you buy the stock and sell OTM. What is OTM?
On the
Out of
money.
money.
Out of the money, right?
Out of the money.
OTM. So you sell an OTM call, and that is called the covered call. So you don't want to sell ITM call, right? Because it will be exercised immediately and you will lose your stock, right? If it is already in the money, it is a good chance that you will. So the idea here is you want to keep the stock, but get some income, right? It is an income strategy. It is not a capital gain strategy. It is adding some additional income into to dividend. Dividend is your income. In addition, you also get some premium by selling a call, right? So both risk and reward are capped. So which is really good thing. The only problem is if the stock goes up too much, you lose out on the appreciation, right? So in this strategy, maximum risk is stock price paid minus call premium, right? So because if the stock goes to zero, you might lose. You still have the stock, right? You have the premium, but you might lose the whole stock. And the other thing is you are obligated, right? Because you are selling the call, you are obligated not to sell your stock until the expiration, right? So that is another problem. So if you have the stock and if you sell a call, then you have to hold on to the stock until the expiration date. Otherwise, it becomes naked, right? So it is no longer a covered call. You should not be selling. If you think that you may be selling a stock, you should not be selling a covered call, right? And maximum reward is call strike minus. So I think maybe it will be clearer if we see the example. So before that, we will just cover this slide. So advantages, generate a monthly income, and it's a lower risk than simply owning the stock, right? Because you are getting some premium to compensate for potential loss of the stock value, and can profit from range bound stocks. If it is not going up, it is not going down, then you can still make money with covered calls. So this is a good strategy for stable market, right? Stable market, you already own some stock, just keep selling covered call, collect premium. Next month, sell more covered call, collect premium. So you can keep going like that, right? Okay, disadvantage, you have to have the stock, right? So that is the disadvantage. You have to have enough money to buy the stock. So some traders consider this to be an expensive strategy in terms of cash outlay. But if you are already an investor and if you already have the stock, then it's not a problem. This disadvantage is not applicable. For regular stock traders, this is not true, right? So for traders who only trade options, this is true, right? But it's not particularly relevant. Capped upside if the stock rises, right? So that is the disadvantage. So if you sold a sold a call, but the stock price has gone up tremendously, then you will miss out because even your rewards are limited, right? So unlike like just buying a call where the rewards are unlimited, by selling a call, your rewards are limited. And this is the example for this is the this, this is the example for covered call, right? So you bought a stock for 28.20 and you sold a call for 90 cents, right? So you already got the 90 cents. So you have compensated some of the stock value by collecting the premium. 2730 is your net outflow, right? Maximum risk, you might lose the full 2730 if the stock goes to zero, right? You're owning a stock, and if it goes to zero, then you lose the whole thing. And maximum reward is you might you have already made 90 cents in the premium, and because your strike price in this example is 30. Sorry, Vinod, are you saying something? So $30 minus 2820 is 270, right? So that is the maximum reward. So your maximum reward is limited to premium plus slight appreciation of exercise price minus the stock price. And break even is I mean, I think once you have the slides, you can go through it later, and I will be sharing the video as well. So if you this may go above your head right now, but you can listen to it again.
The third line actually should be sell the March 2004 strike for $30, right?
Yeah, it's missing. Missing $30. Well
Yeah.
spotted, Dinakar.
Yeah.
So you get brownie points. break even as long as the stock is like 2730 or above, you are still making money, right? So because because you are paid only 2730, you are still making money as long as your stock is more than 2730, and this is the percentage, so it doesn't matter. Okay, so I think those are all the slides I wanted to cover today. I will show you what is in the appendix. So I covered this last time, and they said they don't want to talk about it because they just want to focus on intermediate novice strategies. So I put it in appendix. You can read it later. This is the naked put, which we discussed a lot, and naked call, which is risk. See here, risk is uncapped, which is dangerous. And I also have some graphs for different things, different strategies. Right, so all those strategies you will be able to figure out. So this is the profit and loss graph, right? So this is the premium and what is the strike price. So if you don't understand this, we can ping me or something. So we have some explanation of intrinsic value and extrinsic value, which includes the time and volatility. So there is some explanation here. And there is an impact of security price on option premium, impact of length. So how is the option price determined, right? So there are a lot of factors. It is the option life, it is the premium, variability, stock variability, all those things affect. So options calculations is not just plus this minus this. There is a lot which goes into this, because there is a time value, there is a volatility value, and there is an intrinsic value, all those things. And there is, if you hear the term called leaps, that means there's a long-term option, right? So normally, typically you buy options for like 3 months, 6 months, like that. Whereas you can buy options for like 1 year, 2 year, like this, up to 2.5 years. And that is called leaps. It is the same concept, but it is just the longer term. And buying call options for leverage. This is the one I was trying to explain before, right? So when I was explaining, when I started the meeting, call options to limit risk. So there are a lot of information here and in the appendix. So obviously we don't have time to go through all those. And let us see whether we can, whether are there new people who joined. Abhinav has joined. Yeah, if you guys want to share your video, we can take another snapshot.
I think Uday has joined. I think I saw his name there. Yeah, Uday has joined.
Abhinav, how are you, man?
Hey, Nari, I'm good.
Yeah.
Very nice session.
Yeah. Yeah, please share your video. We'll take a screenshot and share.
Do you see my video now?
Yeah, I see.
Okay, good.
So I don't.
Hey, Abhinav. Hi.
Hey, Bisham, how are you?
Yeah.
Good.
Okay. Okay, we'll just take one more. Okay. Yeah. Okay. So okay, before we wrap, any questions, guys? Yeah, I know it is a lot to take in. There is a lot of material, but yeah, believe me, this is only.
Yeah, Nari, I didn't understand. Sorry, the 11 times I didn't understand the concept. When you stock doubles the thing.
Leverage.
Yeah.
Leverage. Okay. So Shashank, I think you understood, right?
I got it. Yeah.
So why don't you explain it to Bisham?
I think I'm gonna hang up, man. I don't have the patience that you have.
Yeah, explain it. I think you understood.
Yeah, no, I did. Okay, so let's say you buy. Let's say IBM is trading at 100, right? And you buy if and you had $10,000, right? And so if you had to buy the stock of IBM, you'd buy 100 shares of IBM for 10,000, right? But let's say the premium for IBM is trading at, I don't know, $2, say, for a strike price of $200 and 3 months, right? If IBM doubles, so $2 for $10,000, you get what? I don't know, what is that? 5,000 options, right, Nari? Is that right?
$2 is the premium, right?
Yeah. So you
So 200 is the premium, right?
You wouldn't buy the same amount, right? So you bought only like so let us say the option premium is selling at $10, right?
$10, okay.
So instead of outlaying $100 per stock, you are outlaying only $10.
$10 per stock, right?
Yeah, you are only paying $10
per
premium.
stock, right?
But when the stock goes from 100 to 200, it is very likely your option is going to go from $10 to $110.
$110, right?
Because of the intrinsic value, right? Because it still allows you to buy at $100, right? So that is why you get the intrinsic value appreciation,
right.
and that is how you get the leverage. So $10 becomes $110. That is why you get 11 times.
11 times, yeah.
So just trying to understand the breakup. How much? So I understand you will make 10,000 in the capital gains, right? Because it doubles, right?
Yeah.
But how much is the premium worth at the 200 price? What's the?
Yeah,
that's
what he's saying. It's 110.
It'll be
110 times 100. Okay.
Yeah.
Okay, so that you are pocketing. Okay, got it.
Yeah.
Okay.
That is
The
pure
premium is 110.
Yeah.
Actually, those YouTube videos are pretty good, Nari. So
yeah. I shared YouTube videos. So it is a long haul, right? So this is I just want to give you some introduction, but you guys have to spend a lot of time. And if you want to, actually, I will post the link. TD Ameritrade has got a free 4-day option session, right? So from 7 p.m. to 8:30 p.m. on Monday, Tuesday, Wednesday, Thursday, right? Next week. So whatever I have given you, it will help you a little bit, right? But they will start from beginning again, right? So TD Ameritrade, if you go to TD Ameritrade events.
But is it the same content or is it just very different, right?
No, it will be obviously they are spending 4 times 90 minutes. So that's like, 6 hours, and they will be going into a lot more detail, right? So, but I think they cover the same strategies. I don't think they are covering advanced strategies. It is just basic option, but they will go into nth degree of explanation because they will be spending 6 hours on this.
Hey, one question is,
I gotta go, guys. Thank you so much.
All this profit is short-term profit, right? So you paying the tax on the short term.
Problem.
Right?
That is the problem. So it may be better to trade in your IRA account, because IRA account is not taxable immediately.
You can do.
So is that 15%? what is the taxes are what? It's capital gains,
No,
right?
no,
So
no,
Short
no,
term.
but that's short term.
Oh, short-term
Your-
capital gains, so
your
20%.
tax bracket.
no, it
No,
is
not
at your
20%.
income tax
That's
Your
your
level,
tax
income.
bracket.
30-40%. Yeah.
Jesus Christ. Okay, okay, yeah, okay. Oof.
So if because but you can trade options in your IRA account. If you have a IRA account, then you can trade options in that, and that is not taxable immediately.